Today on the Blockchain Report, Bitcoin's holding steady at 118K, and it might be because Trump's company recently dropped $2 billion on Bitcoin right before the US Treasury got its chance. Tom Lee says we're going to 250K this year because apparently charts now double as treasure maps, and Senate Republicans release another crypto bill because regulating digital assets clearly requires more plot twists than a Christopher Nolan film. All that and more right now on today's show. Let's go! Good morning, my crypto cowboys and Satoshi disciples. You're watching the Blockchain Report, the only show where Bitcoin is king, altcoins are background noise, and I'm Hank Hudson, coming to you live from the Bay Area. It's Wednesday and Bitcoin's holding strong. The SEC is still allergic to innovation, and the only thing flipping faster than JPEGs are the narratives on X. But before we dive into the $3 million price target, Senate bill drama, and why Telegram might secretly become the next Coinbase, punch that like button like it's that kangaroo that went viral for trying to steal that guy's dog, and follow Hank at RoxomTV and RoxomTV on whichever app still has working uptime and fewer bots than OpenSea. Now, before we get into the headlines of the day, let's check the charts in this morning's market rundown. Let's take a peek. Okay, so the markets have been looking great as of late. Let's see if today is more of the same. It's not looking great today, but hey, we were due for a bit of a drawback after all the green we've been seeing here in the last few weeks. Right now, Bitcoin hovering just above 118K. Again, about 2 weeks ago, we saw the new all-time highs of just below 123K. Right now, we're stuck in a bit of a holding pattern, but we'll see. We do have some bullish news on the horizon for you today, so stay tuned because I think we might see an uptick in the near future. Ethereum, been riding the wave as well. However, they are down about 3.5 percentage points today, sitting at just above $3,600 a coin. XRP also not feeling great today. Brad Garlinghouse is crying into his pillows as they're down nearly 7.5% this morning, sitting right around $3.29 a coin. Cardano also not a great start to the day, down nearly 9% this morning. It seems like everybody has had a bit of a drawback across the cryptoverse, and Dogecoin is no exception as they're down nearly 9 percentage points themselves as well, right above that 24-25 cents mark. Let's take a peek and see if things are looking any better in the stock market, and for the most part they are. Right now the Dow Jones is up 200 points this morning, right around 44,700. The NASDAQ sitting tight right beneath $21,000. The S&P 5, they're up about 0.28 percentage points this morning, so not a lot going on in the whole. As far as individual stocks, though, MicroStrategy, as it usually does, is following the path of Bitcoin. We've seen Bitcoin have a little bit of a drawback here this morning, and we can say the same for MicroStrategy. They're down almost $11 to $4.15 a share. Coinbase also scooting back with the crypto market, down nearly 3% this morning. Tesla, they're sitting pretty, right around $3.33 a share. Nvidia is up 1.5 percentage points, and GameStop is chilling right at $24 a piece. So we got a lot to go over this morning, including we will be joined by none other than our resident chart shark and crypto wunderkind, Luca Pagano. And Victor, what else we got coming up on the schedule today?
Security matters. Zapper Bank, the only way to bank your Bitcoin. Apply now at zapperbank.com.
Oh, it's beautiful, Hank. This is not financial advice.
All right, and joining us on the show this morning, we're giving a big welcome back to our favorite resident chart shark and crypto wunderkind, Luca Pagano. And where are you, Luca? Are you stuck in a time lapse? How are you this morning?
Hey, Hank. How's it going?
It's great to be here again. So thank you for having me.
Oh, it's so good to have you back, Luca. So I want to talk about the markets right now. Bitcoin hovering at around that 118K mark. We saw all-time highs just like 2 weeks ago, but it seems like we're stuck in another one of those coiling patterns, waiting for the next big breakout. What are the charts telling you right now, and what are you seeing out there?
I mean, Bitcoin has been behaving beautifully since last we talked. To be honest, we have seen this bull flag. Remember, in the latest weeks, uh, I was a bit doubty in terms of the waiting because when you have this breakout, I remember very good this last breakout of this bull flag. Which got us waiting. And I was like, are we gonna really break? Because we should do it like very quick, and it should leave everyone behind. And I think that's actually what it did. It brought two very big green candles, which is lovely to see. Which means people are gonna be chasing prices, and I think that's what happened, honestly. And now we're having, of course, the digestion of this big movement up, which is, we love to see it.
Right. So one thing that can't be ignored right now is it feels like we might be entering the quote-unquote altcoin season, as we have seen some massive gains across the board in just the last month.
Yeah.
XRP's been up like 70%. Ethereum, finally back from the dead, is up like 60%. Are people starting to take profits as a result of those new Bitcoin all-time highs, chasing those higher alpha plays? What are you seeing out there?
I mean, I think you said it perfectly, honestly. I mean, on Ethereum, I'm very happy for Ethereum, because I remember very vividly that we marked this low. Remember, that was a very big low in terms of a weekly perspective, and it was the best low we've catched. It's insane. And also it was, I remember, because this is a very good psychology class, because it was when everyone thought Ethereum was trash. So I think that's beautiful to see always, that the market can help us understand the psychology of the traders, where if everyone's pessimistic, too pessimistic about something, and it just keeps on falling, and it's like free short money, you better pay attention to that and see where the opportunity lies, right? So I think, I mean, Ethereum has been beautiful to see. We've got this very nice push in terms of FBTC last week. I'm expecting, honestly, just a short term, little pullback, but I expect this to continue at least for the 0.4, like 4 cents on FBTC, because I mean, it's been strong. It makes sense for the charts to start reversing here. And also, as you were saying, I mean, Bitcoin has been having great pumps. I think rotation is definitely happening. If we see also Solana, which is good to see as well. Remember, we had this big push down. We've seen, I mean, we've foreseen this range to be held, but yeah, we had this amazing push, very natural, very good, and very strong. So we'll have to see that.
Yeah. Do you account this most recent push with ETH as a result of that profit taking, or could it be other factors? It kind of seems like Ethereum might be returning as one of the darlings of the cryptoverse, as right now we're seeing corporate treasury strategy plays using Ethereum as opposed to Bitcoin. Do you think that's part of the catalyst for this most recent Ethereum surge that we've seen in the last couple of weeks?
I mean, I think that definitely helps in terms of narrative, But to be honest, when we see the chart shank, especially in a weekly time frame, I think the bottom of Ethereum has been there all along. I mean, for me, it was one of the clearest bottoms I've seen in a while. Everyone was shouting here, "We gotta leave Ethereum. This is, it's the end of Ethereum," and whatever. and we still are in this big range we've been accumulating since 2024. So for me, I mean, now the opportunity is different, you know, because we're in the high range almost ish, you know. For me, this is the high range of Ethereum in terms of historical. Of course, this has a good way to go, right? Because from here to there, you have like 12%, say. But for me, what I will be very following very closely and paying very much attention is if we happen to finally break $4,000. For me, that will be a change in trend in the Ethereum cycle, to be honest. And that's where I think like real rotation can happen between BTC in terms of cycle.
Yeah. So here's one for you. We had our other soothsayer on the show earlier this week, Carlos Meslatan, as you know well, and he was predicting that in the next 2 months that we're going to see price targets for Ethereum at $7,100. He thinks Bitcoin could go as high as $159 and Solana as high as, I think he said, $345. Again, this is not anyone's financial advice for anybody, just your professional opinion. What are you seeing from those three in the next 3 months? What are the target prices that you're keeping an eye out for as we make our way into August and then through September?
Great. I mean, for me, like for visualizing targets, what I love to do is to draw up a little bit of Fibonacci, you know, because I think it helps a lot in terms of what we should expect to see in terms of the movement and what we've seen in the past, you know. So in that sense, I mean, Bitcoin has a very clear leg up that starts on, remember, we analyzed this together as well, Hank, on the correction of April, where we touched, you know, $75,000 or so. So for me, that's where the push starts, right? For the next leg up. We had this push that comes from 74, let's say, to $111,000 or so, right? And then we have this pullback to $98,000. So from low to high to low, and when will the next leg finish? Well, Fibonacci tells us the first target is $135,000 and the second target $145,000, and then we'll see. You know, that's at least my plan for this next leg up. That started, of course, in $109,000.
Yeah. What are you feeling like is the new floor we can be expecting right now? Because I'll be honest, I expected once we hit those all-time highs and we retrace back, I was expecting a pretty significant pullback, maybe down to the low 110-ish area, but we haven't seen that yet. What do you think is the new floor for Bitcoin right now based on the movements we've seen recently?
Yeah, in terms of the floor, for me, it's key and critical for us to stay above $110,000, $111,000. Why do I say this? Because this was the last range high of our accumulation. Remember, we were accumulating all this range. So let's paint a little bit. We had this clear range. This was the range low, and this was the range high, just to be a little bit, you know. So we had this bouncing. We deviated, right? Now we bounce, and now we're trying to break out of it, right? So if this goes below $110,000, $111,000, for me, this is just another deviation like we did here. And this is very important for us to understand because psychology can kill us here, Hank. So we deviated the range technically here, right? We came back up and we are trying to break out of it. If we come below here, for me, this is just another deviation. We should continue to trade the range. So for me, that's why it's very important for us to just we should maintain this zone, you know, which is the red zone, and if we can hold this, we're very much into a breakout, heading into $135,000 and $145,000 for me as targets, you know.
Love to hear it, Luca. And I know you got a hard out today, so we're going to let you go. Before we do, though, if our audience hasn't had enough of your chart analysis and they want more, what's the best place to send them?
Yeah, I mean, I will try to keep this updated at Luca at Roxom, and of course, you can follow us on this very on this nice show that it's beautiful, and we'll see you on Friday, I guess, Hank.
Oh yeah, hi, Hank. We're having a crypto bill. This time it's from the Senate Republicans, and the bold new Bitcoin prediction. Stay with us. We'll be right back.
Security matters. Zapper Bank, the only way to bank your Bitcoin. Apply now at zapperbank.com.
All right, we're back with this morning's bull run, and sorry about that little audio snafu. I keep telling everybody here I'm a Duracell guy, and these Energizer ones just aren't cutting it. They don't make batteries like they used to. But let's get back into the news because we got a lot to cover today. First up, because apparently one bill just isn't dramatic enough, Senate Republicans have now released their own draft legislation to regulate the crypto market. It's called, wait for it, the Responsible Financial Innovation Act, a name that practically screams this will go nowhere fast. The bill was introduced by 4 GOP senators, including crypto's unofficial senator-in-residence, none other than Cynthia Lummis. This Senate version builds on the Clarity Act, the House bill that passed last week with bipartisan support. Senator Tim Scott says his colleagues in the House and Senate share the same goal, to, quote, provide clear rules of the road for digital assets. Which sounds great, except the crypto road is currently a pothole-ridden alley between the SEC's basement and Gary Gensler's rejection folder. Now, to be fair, the House did get something done. They passed 3 crypto bills last week and even managed to get the Genius Act through both chambers and onto Trump's desk for a signature. But this new Senate bill, it's still in discussion draft mode. According to early details, the Senate draft includes changes to the Securities Act of 1933 because nothing says modern crypto regulation quite like dusting off a law written before zip codes existed. Both House and Senate bills aim to clarify how the SEC and CFTC should divvy up oversight duties. You know, the same agencies that have spent the last decade playing regulatory tug-of-war over who gets to sue your favorite altcoin. Now, this Senate bill even throws in amendments for ancillary assets, basically crypto tokens that aren't securities, which sounds good unless you're the SEC. Liat Shetret from Elliptic summed it up best, saying momentum is growing, alignment is improving, but the actual passage, that's going to take a while, especially with summer recess and the ongoing political cage match in Congress. Right now, Republicans have a slim majority in the Senate, but any tiny change in the bill's wording could trigger a fresh round of posturing, finger-pointing, and hearings where 70-year-olds ask, what is a cold storage wallet? Now, the bottom line here is we're inching toward real crypto legislation. But until this market structure bill actually becomes law, the only clarity we've got is that DC will keep doing what it does best. Release drafts, hold hearings, and pray someone else takes the blame when things go sideways. And Trump's company, if you weren't paying attention, they just bought $2 billion worth of Bitcoin. And Max Keiser, the Bitcoin OG and El Salvador advisor, he's having none of it. He's calling it the Great Bifurcation, which sounds like either a dystopian novel or a high school band name. Either way, he says Trump is front-running Americans by loading up on BTC through his company before the U.S. National Reserve Fund gets a crack at it. On Monday, Trump Media, yes, the folks behind True Social, confirmed they spent $2 billion on Bitcoin and BTC-related securities as part of a broader Bitcoin treasury strategy. And this all happens after Trump signed the Genius Act into law, which greenlights the stablecoin sector and sends a big thumbs up to crypto innovation. Earlier this year, Trump also issued an executive order that asked the Treasury and Commerce secretaries to build a strategic Bitcoin reserve using forfeited crypto, and this is key here, budget-neutral methods like open market purchases. So when Trump media drops $2 billion on Bitcoin before the feds even open their wallet, people naturally start asking questions. Keiser, never one to whisper, went full send, saying before buying any for the reserve fund, Donald Trump is front-running Americans and buying Bitcoin for himself. Others online echoed this sentiment, saying it looked a bit too convenient that Trump's own company got in before the National Reserves did. But Trump supporters spun it as leading by example. That's cute. Like he's a generous Bitcoin Santa, buying now so we don't have to later. I love that photo. Meanwhile, BTC has barely flinched. At the time of writing, it was trading around 119K, just a few percent shy of its all-time highs. Over the past month, Bitcoin's up more than 16%. In the past 2 weeks, we're talking 9.5% alone. In the last 7 days, it's lagged a little with about a 1.7% gain, slightly underperforming the broader crypto market's 5.9%. But if the president and his company are willing to toss in a couple billion of their own chips, that's probably bullish long term, assuming, of course, we don't need a congressional hearing just to track who's holding the nation's private keys. And in other news, if you thought $200,000 of Bitcoin by the end of the year sounded bold, FundStrat's Tom Lee just pulled up in a cape and said, "Hold my ledger." In a new CNBC interview, Lee doubled down on his 250,000 BTC price target for 2025, then casually lobbed out a long-term projection of $3 million per coin. That is a roughly 2,400% gain from where we're sitting today. And according to Lee, it's totally reasonable. Bitcoin's currently hovering around 118K, but Lee insists the market is responding to global liquidity and that this is exactly the setup for the next explosive leg up. Dovish Fed? Check. Rising institutional demand? Check. The emotional resilience to survive another sideways week on crypto Twitter? Well, that part's up to you. Lee's thesis boils down to simple math. You see, Bitcoin is scarce, and the world, it's waking up to it. Gold's market cap is around $20 trillion, Bitcoin about $2 trillion. Now, if Bitcoin even sniffs gold-level valuations, we're in seven-digit territory, baby. He calls it a network value comparison. But instead of trying to convince anyone with metaphors or memes, Lee's relying on actual supply and demand numbers. 95% of Bitcoin has already been mined, right? And only 5% of the global population owns any. That's the setup. And in Lee's words, there's not a lot more potential buyers of Bitcoin over the next 10 years. Or excuse me, there's a lot more of potential buyers over the next 10 years. Or in other words, you better get it now or you're going to be chasing it later. Even his conservative short-term target, 250K by the end of this year, would only put Bitcoin at 25% of gold's current market value. Or in other words, he's calling that reasonable. Because unlike your favorite NFT bag, Bitcoin has a use case, a network effect, and no roadmap to rug. Now, before you accuse Lee of smoking hopium with Mike Novogratz and Rick Edelman, who've also dropped $500 and $1 million Bitcoin price predictions, remember this, Tom Lee called this years ago, back in 2019. In fact, he was telling CNBC viewers to allocate 1% to 2% of their portfolios to Bitcoin when it was around only $5,000. They all laughed at him, then Bitcoin 20x'd. Now he's back with a bigger mic and an even bigger price target. Lee's view is supported by more than just vibes, don't you know? He points to technical momentum, ETF inflows, and consolidation below 120K as signs that institutions are quietly buying the dip and stacking sats. He also highlights a bullish flag breakout that points toward 160K in the near term, with support levels at 116 and 112K, and then a psychological panic level at 100K. Now, unless we break those, it's green skies ahead. And macro-wise, it's even better. Fed rates are expected to drop, liquidity is expanding globally, and Lee calls stablecoins the ChatGPT moment for crypto, the killer app that brings in consumers and validates the entire digital asset space. As JP Morgan, Citi, and others jump into stablecoins, the institutional dominoes, they keep falling. And Bitcoin, it gets dragged up with the tide. No seed phrase required. If Lee's $3 million target pans out, it would be one of the greatest asset appreciations in financial history. And if he's even half right, that's still generational wealth for anyone holding more than a couple of Satoshis. So the next time someone scoffs at Bitcoin being overvalued at 120K, tell them Tom Lee thinks it's still at the starting line, and he's got the receipts to prove it. Next up, Matador Technologies. Well, they're going full sailor mode with a fresh $100 million war chest dedicated entirely to one thing, and that one thing, of course, is buying more Bitcoin. The Toronto-based firm, self-branded as a Bitcoin ecosystem company, just inked a secured convertible note deal with the ATW partners, kicking things off with a $10.5 million opening tranche and a game plan to buy up to 6,000 Bitcoin by 2027. That would make them a top 20 Bitcoin corporate holder globally, and if they hit their stretch goal, they'll own 1% of the world's entire Bitcoin supply, which is basically the modern day equivalent of saying, I don't want a savings account, I want to be a Bitcoin citadel. The structure of the deal is slick, minimally dilutive, price adaptive, and backed by BTC itself. Because nothing says we believe in Bitcoin quite like borrowing money against your Bitcoin to buy more Bitcoin. CEO Devin Soni says the move minimizes shareholder dilution while turbocharging Matador's BTC per share metric. And their chief visionary officer, yes, that is his real title, Mark Moss, he doubled down, saying this shows strong institutional conviction in their model. The secured notes carry an 8% interest rate, a 2-year maturity window, and are backed up to 1.5x Bitcoin collateral, which, let's be honest, is way more backing than the US dollar has right now. Their first purchase tranche converts at 72 Canadian cents per share, and yes, there are no Canadian statutory hold periods because the shares are being issued abroad. The money is going exclusively toward growing their Bitcoin holdings. No metaverse pivots, no chain rewards programs, and no pivot to AI. This is straight up, we're going to accumulate Bitcoin until the lights go out energy. And that's not all. They're also buying at a 24% stake in HODL Systems in India, one of the country's first digital asset treasury companies. So not only are they hoarding Bitcoin, they're planting flags in emerging markets and reinforcing their long-term thesis that Bitcoin is the reserve asset of the future. In short, Matador, they're not playing around. They've secured the funding, structured it like professionals, and made it painfully clear that they'd rather go down swinging with Satoshis than sit on cash. So if you're still wondering whether institutions are serious about Bitcoin, Matador is about to answer that question with 6,000 BTC. And it turns out corporate America didn't just read the Bitcoin Standard, they bought the hardcover, annotated it, and started treating Saylor like their personal shaman. And according to a new Binance research report, 116 public companies now hold a combined 809,100 BTC. That's about $85 billion in corporate coin, or what used to be the US education budget before we traded it all for ChatGPT. This time last year, they were holding just 312,000 Bitcoin. So yeah, they more than doubled their stack because nothing says sound risk management quite like swapping fiat for magic internet money right before an election year. Nearly 100,000 of those coins were added since April alone, which tracks. I mean, April was the same month you said, I'll wait for the dip, and Bitcoin said, LOL, nah. I mean, so what's behind the spike though? I got 2 words for you, President Trump. The man who once offered NFTs of himself dressed as Superman is now overseeing a strategic Bitcoin reserve and a digital asset stockpile. And somehow, that's less absurd than the SEC's previous enforcement policy. You see, since Trump took office, lawsuits against major crypto firms have mysteriously vanished. Kind of like your ETH bag after that one DeFi upgrade. Now, Binance also points to a November inflection point, otherwise known as the moment Trump won the election and every TradFi executive suddenly Googled how to buy Bitcoin without looking like a degenerate. Meanwhile, the Financial Accounting Standards Board, or FASB, finally got its act together and let companies count gains on Bitcoin holdings, aka the bare minimum. Now, it's 2025 and we're celebrating accounting rules catching up to reality. New entrants include GameStop and Paris Saint-Germain, who apparently got tired of sponsoring soccer jerseys and decided to just go full on degen. But the undisputed giga whale, of course, is Strategy. They're hoarding over 70% of the BTC in corporate treasuries like it's canned tuna in a bomb shelter. Altcoins are trying to sneak in through the side door. SharpLink holds over $425 million in ETH. DeFi development and Classover are flirting with Solana. Weebus, a Chinese firm with Bond Villain Energy, just filed for a $300 million XRP reserve. But let's be honest here, boys and girls. Most of these altcoin plays are just rebrands for companies hoping no one remembers their Web 2 flop era. Binance also flagged the rise of tokenized real-world assets, RWAs, for those who like their buzzwords alphabetized. Now, they've grown 260% this year, jumping from $8.6 billion to $23 billion, because apparently what real estate needed was smart contracts. So the bottom line here is Bitcoin isn't just for libertarians with hardware wallets anymore. It's for CFOs, boardrooms, and anyone who finally admitted that cash earns less than a Subway gift card. Welcome to the new Treasury standard, my friends. Now go update your corporate strategy deck, or else. In other news, Telegram has officially turned into a crypto wallet with a chat feature. As of this week, its built-in Ton wallet is now live for all 87 million US users. And no, you don't need to download anything, install any sketchy browser extensions, or memorize a 24-word riddle from Satoshi's diary. It's built right into the app. Welcome to 2025, where your group chat might accidentally become a decentralized finance hub. Now, the Ton wallet, developed by the Open Platform, or TOP, because every crypto company needs a vague acronym, is a self-custodial crypto wallet. That means you control your own private keys. And if you lose them, well, that sounds like a you problem. But don't worry, they've got a split key backup system that ties one part to your Telegram account and the other to your email. So yeah, your Hotmail inbox from 2007 may now be a linchpin in your financial sovereignty. With the Ton wallet, users can send stablecoins and tokens to their contacts as easily as firing off a text. Peer-to-peer transfers? Check. Token swaps? Check. Staking? Double check. Zero-fee purchases through MoonPay? Also check. It's basically like Cash App, if Cash App let you send money using frog memes and anime stickers. More than 100 million people activated the wallet globally in 2024, but the US launch was delayed due to regulatory headwinds, which have recently shifted in tone. According to top CEO Andrew Rogozov, things in the US have become more interesting, as he put it, which is corporate speak for we think the SEC won't sue us this time. Now, Rogozov says that the Ton wallet is now a core part of Telegram's infrastructure, giving users not just a way to store digital assets, but also interact with Telegram's mini apps. Because if there's one thing the world needs more of, it's staking yield while playing a Telegram-based Tamagotchi game. Let's rewind things here a second for context, shall we? Telegram originally abandoned its own crypto token back in 2020 after the SEC cracked down harder than a boomer reading a gas bill. Since then, Telegram has kept its hands clean while quietly supporting Ton blockchain from a distance, kind of like a helicopter parent yelling from the bleachers. They now offer tokenized usernames, stickers, emojis, and even a collectibles marketplace called Fragment, all built on Ton. So while they don't technically run the blockchain anymore, they definitely brought the snacks. Now, this US rollout could create serious problems for Coinbase, Cash App, and anyone else trying to be the Venmo of crypto. Because now you've got a fully functioning wallet with swaps, on-ramps, and stablecoin support embedded into an app that people are already using. And let's not ignore the obvious here. Telegram is massive in the crypto world. From degens to group chats, the entire token launches coordinated and pinned messages, Telegram just happens to be where Web3 lives right now. And by removing all friction, so you're talking no separate downloads, no remembering your seed phrase, and no awkward KYC hurdles on the front end, Telegram may have pulled off what Meta never could: mainstream crypto integration inside a mainstream app. They even partnered with licensed providers like MoonPay to handle the regulatory red tape for them. No securities offered, no DeFi gambling hub, at least not officially. So while the Ton wallet rollout avoids stepping on SEC landmines, it quietly makes Telegram one of the most powerful crypto gateways on earth. And unlike Coinbase, there's no need to wait for Apple to approve the update. We going to break, Victor? All right, we're going to break. We'll be back in a second, so stay tuned. More blockchain report coming your way.
Security matters. Zapper Bank, the only way to bank your Bitcoin. Apply now at zapperbank.com.
All right, welcome back. It's time for a little blockchain without borders. So let's see what's going on in other parts of the world. Well, a London gang, they tried to pull off a high-stakes crypto heist. Instead, they got a Belgian barber, $9 in a wallet, and a cautionary tale about believing your own Instagram feed. Man, those London gangs are scary looking. Now, Quentin Sepajak, the victim, had been flexing online about his supposed Bitcoin fortune, which, spoiler alert, didn't exist. One of the gang members, a woman named Davina Raymakers, befriended him online and offered him a luxury flat in London. Sounds romantic. Turns out it was a trap. When Quentin arrived in Shepherd's Bush, he was ambushed by 3 men, including Raymaker's boyfriend, who held a machete to his neck and a knife to his leg. They demanded his crypto. He showed them his wallet. It had $9 in it. They recalculated their ambitions from 67 grand to whatever his bank account would let them scrape together. They settled for $2,700, let him go, and are now serving time. All 4 admitted to blackmail in Isleworth Crown Court, and police reportedly tracked them down using Airbnb and phone data after meeting Quentin at St. Pancras. Whoops! This little fiasco is part of a growing trend known as wrench attacks. And no, it's not a type of new altcoin. It's when someone decides they don't need your seed phrase if they can just threaten your life instead. And the crypto world's obsession with flex culture, showing off NFTs, wallet screenshots, and first-class conference flights is basically serving these attackers curated menus of the victims. Now, one TikTok influencer in France learned that the hard way too. They were kidnapped over a fake fortune and released once it became clear that it was more broke than viral. According to Eyal Grouper, who's the CEO of a Bitcoin recovery platform, these attackers are lurking in the same channels as you, watching your stories, tracking your hashtags, and taking notes every time you mention how many Satoshis you're holding. So maybe next time you buy a Bitcoin hoodie with "Crypto made me rich" on it, don't wear it to the airport. Or maybe ever. And in other parts of the world, it's official. Bitcoin diplomacy is now a thing. El Salvador, the OG Bitcoin nation, and Pakistan, the surprising up-and-comer, have just pledged strategic collaboration in all things Bitcoin. On July 16th, El Salvador's Bitcoin office and Pakistan's Crypto Council signed a letter of intent that basically says, let's team up and go full maxi. According to the statement, the 2 countries plan to explore working together on Bitcoin education, Bitcoin mining, sovereign Bitcoin reserves, and using Bitcoin to power financial inclusion and economic empowerment, which is a really polite way of saying, let's ditch the dollar and teach our kids how to hodl. Pakistan's government put out its own statement confirming the deal creates a formal channel for knowledge exchange and cooperation. That means they're trading more than just memes. We're talking public sector adoption, blockchain inclusion policy, and probably a few Telegram groups. And if you think this is just a PR stunt, Pakistan's Minister of State for Crypto and Blockchain, Bilal bin Saqib, made it crystal clear where he stands. He called President Bukele one of the most extraordinary leaders of our time, saying he doesn't just talk tech, he challenges it. From AI to robotics to Bitcoin. Saqib went so far as to say El Salvador is writing the blueprint for the world, which is a bold statement considering most of the world still thinks their Bitcoin wallet is something you buy on Etsy. But this isn't Pakistan's first move. Back in May, they announced their own strategic Bitcoin reserve and made it very clear it's not for flipping JPEGs or joining hype cycles. In their words, we will be holding these Bitcoins and we will never, ever sell them. You know, unless there's a debt crisis or something. But still, points for conviction. Since then, Pakistan's gone full Web3 nation-state speedrun, launching the Pakistan Virtual Assets Regulatory Authority, a new body to regulate and oversee their fast-growing crypto economy. And it's not all small talk. A report from the Asian Development Bank says Pakistan ranks 8th globally in crypto adoption. That's $20 to $25 billion worth of digital assets held by Pakistanis. Not bad for a country whose central bank in 2018 called crypto not legal tender and told exchanges to cut it out. Now, they're shaking hands with Nayib Bukele and promising to never sell their coins. Meanwhile, El Salvador keeps doing what El Salvador does, and that's stacking sats. The government claims they've been buying 1 Bitcoin every day since November of 2022, because if dollar cost averaging is good for retail, it's even better for sovereign treasuries. This alliance may not seem like very much right now, but a few years from now, when countries are fighting over mining rights, energy deals, and Bitcoin secured trade agreements, this little letter of intent might be seen as the ground zero for geopolitical rise of the Bitcoin alliance. It's not quite NATO, but it's proof that Bitcoin is no longer just an asset, it's policy. We're taking a break, but when we're back, we have our interview with James Seyffart from Bloomberg. We'll be back with him and more right after this. All right, welcome back to this morning's Bull Run. And joining us today, we've got a special guest. He is one of the sharpest minds at the intersection of ETFs and crypto, a trusted voice for institutional investors, and a guy whose Bloomberg terminal work probably helped half of you pretend you understood fund flows. A CFA, a CAIA, and an analyst who's been tracking Bitcoin ETF developments since before they were cool. He's not just watching the market, he's helping shape how we understand it. Please give a big blockchain report welcome to the man who makes asset management analysis look exciting, Bloomberg Intelligence's very own James Seyffart. James, welcome to the show. Me and our audience here are thrilled to have you. Thanks for joining us today.
That was quite the introduction. That was one of the best introductions I think ever had. Thank you for that. You made me sound cool. Not easy to do.
You know, I do what I can, and you're at the cusp of a very cool industry right now, so I thought it was fitting. But for those in our audience that aren't familiar yet with you and your work, can you give us a quick overview of what you do at Bloomberg Intelligence and how you ended up becoming one of the go-to analysts in the ETF and crypto space?
Yeah, I mean, I'll give you the shortened version, as short as I can get it. Just Bloomberg, for people who don't know Bloomberg, most people know them for the news that they do, but really what Bloomberg is known for is the Bloomberg terminal, right? And they're sending out data and information. We're aggregating tons of data on a whole bunch of different things. I specialize in the funds world, so think hedge funds, mutual funds, mainly ETFs. And in 2017, I joined our Bloomberg Intelligence Department, which is basically just Bloomberg's research department, right? We're out there writing research about what's going on in the ETF industry. And I've been covering what's going on with the overlap between crypto and ETFs, or DeFi and TradFi, since as early as 2017. So mainly started with like the Grayscale Trust. I was doing a lot of work on, those discounts and premiums for our institutional clients, and sharing a little bit of it on Twitter. And obviously, I've been covering the ETF saga to try and bring crypto and Bitcoin ETFs to U.S. retail investors for the same amount of time. So that's really where my sweet spot is. And fortunately, we've been correct enough. Myself and my boss, Eric Balchunas, we were out of consensus calling for the approval of Bitcoin futures ETFs many years ago. We were early to say and are confident to say that we thought the spot Bitcoin ETFs were going to get approved back in 2023. And yeah, so we've been fortunate enough to get a lot of these things correct. And now we're just kind of focusing on what's going on. And basically the way I see it is there's two solar systems, TradFi and DeFi, that are, merging together. And it's going to be a huge process over the next decade or so of these bridges being built between those two types of systems.
Yeah, absolutely. And we are super excited to have you and your background and experience with us to talk about some of these big stories again, because you are the perfect person to get some insight as to what is going on in the world right now. Because we're in crazy times. It's fun, it's exciting, and it's moving quick. And we're happy to have you and your guidance here to chat with us today. So hang tight, James. We're going to go over this story. We're going to bring you right back and get into it. Sound good?
Sounds good.
All right, rock and roll. First up, Paul Atkins is on TV again, and this time he's sounding like he wants to be the prom king of crypto high. The U.S. SEC chair was on CNBC and delivered what might be the most bullish bouquet of bureaucratic fluff the industry's gotten in months. He called Trump's signing of the Genius Act a watershed moment for crypto. Let's take a listen, see what he had to say.
So I thought this is a really great watershed and thanks to the President for his leadership and the Congress for getting this out and getting that bill to the President's desk for signature. I think this bill the Genius Act is focused on payment stablecoins, and so that's not really within the SEC's ambit of regulation, but it's really for the banking regulators, as is appropriate. But the one great thing about this is that for the first time now, the United States government has put its stamp of approval on a very key and important, potentially very important digital asset that will, I think, help to lower costs, lower risks in the market, because we can now move towards an instantaneous almost settlement of payment versus delivery for securities, thanks to on-chain stablecoins. And that will help, I think, innovation and to really get our markets, to be the best in the world.
Now, in addition to this, Adkins also dangled a juicy carrot, saying the SEC is exploring new steps for registrants using stablecoins, including settlement and margining. But here's where it gets really spicy. Adkins went rogue and declared that Ethereum, that thing Gary Gensler couldn't define without having an aneurysm, is not a security, just like Bitcoin. He went even further and implied that most tokens might not be securities either. So everyone gets a free pass? Well, he was responding to a question about companies copying Michael Saylor's playbook and loading up their balance sheets with either Bitcoin or Ethereum. Adkins played it coy, saying it's not his job to tell companies what to buy. But he was clear that it's encouraging to see the market embracing digital assets. All right, we're bringing James back. James, the SEC chair just said Ethereum isn't a security. How big of a deal is that, and what does that change going forward?
Yeah, I mean, it's nice to see like an SEC chair actually give an answer. Like we could play clips of Gensler sitting in front of Congress, in front of anyone of any substance, asking him questions about what is security, what isn't security, and he just danced around the question left and right. For the most part, from my point of view, something I've been saying for a long time, I did not view Ethereum as a security. I thought it was a kind of a witch hunt that the SEC went on. Up until they basically approved the Ethereum ETFs, they were they were sending out Wells notices. They were trying to interview people, sending out subpoenas, trying to basically say that the merge, when Ethereum went from proof of work to proof of stake, might have made Ethereum a security. They went after Joe Lubin. They went after pretty much everyone involved in the space. And I think what happened was the SEC realized there was nothing they could do. So from my point of view, when they approved the Ethereum ETF, that was the nail in the coffin that Ethereum was not a security, it was a commodity. Gensler liked to say that some things could be a security in some instances and commodities in others, and refused to give it up. But from my point of view, this is just saying what the market has already accepted. Ethereum was not a security. It hasn't been a security. I know there's a lot of Bitcoin maxis that don't like to hear that. My personal view is it likely would have been considered security when it went through its ICO initial coin offering. But it has since become decentralized enough in the way that it operates. I don't view it as a security personally. And I think it's a good thing the SEC views it that way. The other thing I would add that the SEC is working on right now is something that we would, in the ETF world, refer to as generic listing standards. Basically, it's a framework and rules around like what assets can go into an ETF wrapper and what requirements are needed to fit into an ETF wrapper. And that's something that we know for a fact the SEC is working on right now that'll be critical to determining what ETFs are going to come to market in the coming months, or basically what assets are going to make it into the ETF wrapper in the coming months.
Mm-hmm. And Atkins even went a step further, as he also hinted that most crypto tokens might not be securities after all. Do you think that this signals a real shift in how the SEC plans to regulate the space moving forward?
I think this is the right way they should be doing. I mean, Hester Peirce has written a lot of dissents from the way that the Gensler and Biden admin was handling the space. They basically went well beyond what the SEC's jurisdiction was. This is something that Gensler did when he was at other agencies. He kind of pushes the envelope way beyond where his powers may have been. I mean, they went through regulation via enforcement. They were just, in many cases, they were arguing like different versions of the same lawsuits in different jurisdictions to see which ones would stick. Like, it's just not the way that a regulator should operate. So I think that that's correct. Most of these tokens are not going to be securities. Are most of them going to be valuable tokens? Are most of them going to be valuable protocols? Probably not. I think 95+% of the protocols out there are probably going to be worthless. But that doesn't mean that they are securities, and the SEC should be regulating them like securities. And I think that's what's going to come out of that framework I was talking about. They're going to dictate what can go into ETF wrapper by basically saying this is how digital commodities are going to work, or digital assets are going to work, with as far as the SEC framework is going to be decided. So I think within the next year to 18 months, you're going to see, 50 to 100 different tokens put into an ETF wrapper that the SEC basically greenlights, and even things that they do deem to be a security in the DeFi world. Those will be handled just like securities are, right? It's just a different wrapper. So even if things are deemed to be securities, it doesn't mean that they can't be invested in and the SEC can't allow them to exist. It's just like they have to go through a different framework. So I think that the way that Atkins is looking at this is the correct way to look at it. And it's kind of refreshing to hear things from him, and specifically from Hester Peirce, who seems to be pushing the envelope with her crypto task force, and the way that this all should be handled from a regulatory point of view. The question is, are we just going to be sitting here with Atkins and Hester determining what the rules are and coming with ideas? Or are we actually going to get regulation via something like a Clarity Act that will make it law of the land? Whereas right now, so if Atkins and Hester are gone in 4 years from now, when we have a new president potentially, are we going to go back to basically the SEC and CFTC just coming with their own rules and changing what the prior administrations have done? We don't want that. We need a real clear Clarity Act, if you will.
Right. Well, it seems like at least we're headed in the right direction, as opposed to years past. You mentioned we had Gensler, who couldn't seem to answer really anything for us or provide any type of clarity. But now we have this new framework that does seem to provide us some kind of clarity going forward. And do you feel like this new direction might open the door for more institutions to feel safe getting into Ethereum and other assets beyond Bitcoin moving forward?
I think institutions are chomping at the bit for the most part to kind of understand this space. They're all like testing things out on Ethereum L2s and Ethereum and Solana. They're looking to get involved with these other protocols, but for the most part, institutions and TradFi legacy firms, most of them basically discounted this over the last 7+ years, 8+ years. There were some exceptions like Fidelity, ironically, JP Morgan and others that have like built up, the institutional know-how to possibly play in this space. But there's a lot of banks and big institutions that just haven't done anything and are like, okay, we need to get up to speed. And it's just like, you can't just use your typical experts on how TradFi works to like incorporate DeFi systems. So I think it's going to bring in more institutional money. The one thing, if you look back, think before the Bitcoin ETFs were approved, if you look at institutional investors, advisors, the number one reason why they weren't investing in the space, whether that was Bitcoin or Ethereum, was because, one, they didn't know how they could get exposure. So basically, the number one thing they wanted was an ETF. But the real reason they weren't doing it was because there was no regulatory clarity. No one knew how this thing was going to be handled. Are they going to invest in this asset class and then the US government is going to try to shut it down in some way? Are they going to go and attack everyone building in the space? So everyone was sidelined. So as we get more and more regulatory clarity, as things get more stable and understood about how it's going to be handled by the government and different things like that, the SEC, regulators, CFTC, you name it, OCC, the Fed, like as that happens, you're ultimately going to see institutions be more willing, maybe not jump in with 2 feet, but at least dip a toe in trying to understand and put some money to work in the space.
Yeah, absolutely. I mean, we're definitely seeing a new phase of this kind of crypto ecosystem, specifically with legislations being passed. And, a big thing that people have always said about the crypto space is they always talk about the volatility, right? The volatility, it's too volatile. But with all of this recent talk around stablecoins and clearer rules, do you think we're finally heading toward a more predictable crypto landscape than we've seen previously? I know like people say the halving cycles are somewhat predictable, but with this new legislations being passed, do you think things are going to finally start settling down? We might see Bitcoin specifically move more like a traditional asset class, things are changing. What are you seeing going forward in terms of that, the crypto landscape and its predictability? I
mean, if you just look at Bitcoin specifically, and this is true of any asset, if basically the way I view it is a call option, a store value asset, right? That's the way I think of Bitcoin. There are some other things, the peer-to-peer cash payment system that we can get into, what it was originally built for. But basically the real way to think about it is like gold as a teenager. Like a teenager is volatile, right? But if you look over the last decade, on a long enough time frame, that volatility has been going down. The vol on that asset is going down and to the right. So that is just saying like there's more adoption. That's not saying it's not volatile. I don't think Bitcoin will ever be not volatile. So I think that's a good sign if you're expecting to become a store value asset. But I don't know that it's going to completely decrease the volatility. I mean, the way I think about it is essentially maybe those 4-year cycles aren't going to go away completely, but I think the amplitude on the percentage basis is probably going to go down a little bit as more and more bigger traditional stable players come into the market, these TradFi firms. But that's like saying, I mean, the stock market is still plenty volatile. I mean, look what happened in April of this year. I mean, we had the S&P 500 basically go down 20%. I mean, that's not to say that just because TradFi is here that things are going to go down, but are we going to see those 80% drawdowns? I don't think so. Probably not. I think those drawdowns and maybe even the upside isn't going to be quite as volatile and explosive as it has been, because people are likely going to be looking at this as, I'm going to have a 5-10% allocation, and that volatility, I'm going to trade around it. So when it goes up a ton, I might decrease my exposure. When it goes down a ton, I might increase my exposure, which theoretically over a long enough time frame, if people are viewing it that way as a portfolio asset, that again will also decrease the volatility. So I think volatility is going down. I think as we get more regulatory clarity, as we were just talking about, it's going to help decrease some of the volatility and explosiveness. But there's no way to know for sure. People have been saying since for more than just this cycle that the 4-year cycle is over. I'm not necessarily in the camp that the 4-year cycle is over, but I do think that it's likely that it's going to be more muted, particularly with the way that we're seeing all these treasury companies come to market. So right now, I think it's a bit of a flywheel to the upside. I think over some time period, whether it be months or years or maybe a decade, there is going to be some point where potentially some of these treasury companies start causing a flywheel effect to the downside. That's a risk that people need to be aware of. But yeah, I mean, overall, I think volatility is going to be coming down.
You mentioned the treasury companies. What are your thoughts on that right now? You know, you have a lot of companies that are trying to use the Michael Saylor playbook, but they're not in anywhere near the same position as Strategy, who's been doing this now for 5 going on 6 years. Are you concerned at all that this could be a temporary bubble? Because if Bitcoin were to have a 20% drawback, like we've seen time and time again, a lot of these firms are going to be at a much lower price than they bought into. Does that concern you at all with this Bitcoin treasury strategy phenomenon that we've been seeing?
Yeah, so I think there's, like I said, I think there is definitely some risks, particularly with, I mean, every day there's a new announcement of a firm adding Bitcoin or issuing debt to add Bitcoin to their balance sheet. Some of them are seeing massive pops in their share price. Some of them are actually seeing drops. It's also happening with Ethereum and Solana. I saw one for Dogecoin the other day. I mean, you name it, everyone's trying this playbook. Anything in crypto, anything in TradFi, there's bubbles that form. I think there's probably a bubble forming a bit in this space. I think it kind of echoes things. I know this is not at all the same exact sort of situation. Saylor has addressed this exact question, but it reminds me a little bit of GBTC, where there is potential for it. You know, everyone was like, the premium's going to persist forever, and that's the way they're viewing all of these treasury companies. But if you look at GBTC, that I was writing notes, I remember in 2018, basically saying that like this thing could trade at steep discounts and for the same reasons it's trading at a premium. And I can't tell you I've never gotten as much vitriol on Twitter as I did when I was talking about that, because everyone's like, the premium's only going up and all this stuff. So I think there are going to be a bunch of these names that trades at discounts. Does that mean that Saylor and other people are just going to buy them because it'll be a more efficient way to buy Bitcoin because it's trading at a discount in some way? Maybe. Should it trade at some level of premium, just like increasing earnings? Stocks don't just trade at what the value of the assets they hold. I could make that argument. Should it be trading at 2-3x the underlying value? I would argue probably not. So I don't know. There's probably it's a unique system. We're finding out how this is all going to work. So yeah, I think it's a risk. Do I think Saylor specifically and Strategy are going to run into tons of trouble? Probably not. Their balance sheet looks pretty good right now, but I mean, you see a massive drop in Bitcoin, you know how people are going to handle this. Some of these other CEOs. The other side I would say is like a lot of the announcements you're seeing. Yes, some are trying to follow Saylor's playbook, taking advantage of that volatility and, you know, issuing debt related to it for converts and preferreds and different things like that. But there's also even more announcements of just like your mom and pop places or like smaller companies that are like taking 5% of their corporate treasury and just allocating it to Bitcoin. which I think is a positive sign. It's more like how like an individual like you or I would add Bitcoin to our personal balance sheet rather than, levering up to get exposure to it.
Yeah, it's just, you see some like extreme instances that give you pause. I know there's like this Italian coffee company that has 6 shops that's raising, I think, $1 billion for their own Bitcoin treasury. And I'm having a really difficult time understanding how coffee beans can translate to $1 billion worth of Bitcoin holdings. But I guess we'll have to see how it plays out. These are new and unfounded times, and I guess only time will tell, as they say. But hang tight, James, because this next story I want to talk with you about is the man who started all this. Of course, we're talking about Michael Saylor and his corporate alter ego strategy. They are now the world's biggest publicly listed Bitcoin holder. At last count, they got around 607,000 BTC. And if TD Cowen analysts are right, that number could hit 900,000 by 2027. Which would mean Saylor's company controls 4.3% of all Bitcoin in existence. That, my friends, is not a strategy. That is called monetary conquest. Now, some critics say the company's stock, which trades at 72.6% premium over its Bitcoin net asset value, is dangerously inflated. That it's a speculative bubble, and that the only people buying are greater fools. But TD Cowen's Lance Vitanza and Jonathan Navarrete say those critics are, how do we put this, logically flawed. They argue Strategy's valuation makes perfect sense because unlike ETFs or retail bag holders, Strategy can pull off Bitcoin financial engineering that would make TradFi weep. At the heart of its 42-42 plan, Saylor wants to raise $84 billion in capital by 2027, split evenly between equity and debt at a blended borrowing rate of 0.421%. That's less than 0.5% for those of you doing the math at home. And with that cash, Strategy can stack more Bitcoin per share without dilution, create a Bitcoin yield effect nobody else can replicate, and weaponize its capital efficiency to destroy NAV-based logic entirely. It's kind of like if BlackRock and Willy Wonka had a baby and gave it a balance sheet full of orange coins. And that capital flywheel, it's not exactly theoretical. Strategy recently raised nearly $740 million through a $21 billion offering. They used it to buy 6,200 more Bitcoin at around $119K each. And somehow they managed to add nearly 3,000 Bitcoin in profit without issuing new shares. That kind of efficiency means every MicroStrategy share now holds 20.8% more Bitcoin than it did on January 1st, and has doubled its BTC per share ratio compared to just 18 months ago. Now, this isn't a trust fund with a vanity ticker. It's a Bitcoin vampire squid wrapped around the corporate treasury system. And it just launched a new weapon, the Stretch, or STRC, preferred stock, which is designed to raise more cash without watering down existing Strategy holders. Think of it as Bitcoin expansion on easy mode. Now, TD Cowen is so impressed that they've slapped a $680 price target on Strategy stock, citing regulatory clarity, growing institutional adoption, and Strategy's self-reinforcing capital model that makes ETF flows look like pocket change. Saylor isn't buying Bitcoin anymore. He's monetizing it at scale with leverage and a publicly traded ticker. If they hit 900K BTC by 2027, that's not corporate dominance, that's becoming a shadow central bank. And if Bitcoin's price does what we think it might over the next 2 years, don't be surprised if the next asset Strategy buys is your bank. We're bringing back James. James, Strategy already owns over 600,000 Bitcoin, and now they're aiming for 900K. What do you make of that, man?
I mean, it's impressive. I mean, he called a shot 4 or 5 years ago, or whenever it was, and he started doing this. And the other thing, like I mentioned, I worry about people building up leverage to get this exposure. I mean, you're talking about Strategy. You're talking about the amount of money that he wants to put at work here. A lot of people worried about the debt that he's built up. I mean, he doesn't have his next due date for his bonds, his converts is $1 billion in 2028, $3 billion in 2029. And just under $3 billion in 2030. And then he has over $3.2 billion borrowed on his perpetual prefers. One of those, what we just talked about, that he's launching a new one. So, I mean, it's spread out over a long enough time frame. So realistically, like the way this needs to play out for it to be really bad is Bitcoin needs to drop a ton over the time period before like that debt comes due, and he would have to be able to basically not tap the at-the-money sale of his stock when he needs to do it. But again, like, people are worried about it. The difference between strategy and the Grayscale trust that I was talking about was there's no mechanism for a trust to like take advantage of a potential discount. Like if Saylor wanted to in some way and it's trading at a discount, they could find a way to buy back their own shares. Theoretically, that might mean selling Bitcoin and buying back their own shares. I don't know if he would actually go that route, because then it would, kind of unwind exactly where we've gotten now. But I mean, the thing that goes back to, I mentioned it before, does it deserve some premium? I'd argue it probably does. Like, he's been able to acquire more Bitcoin and increase the Bitcoin that you get per share for a common shareholder. And the way to think about that is like, that's the way a stock works. The reason you pay a premium to the underlying value of a company is because you're expecting it to grow earnings. And so theoretically, if you're trying to think about this in the way that MicroStrategy is using financial engineering or what have you, financial alchemy in a way, he's generating more Bitcoin. So theoretically, yes, you're paying a premium to get exposure to the same amount of Bitcoin, but if he can increase the Bitcoin that's owned by those shares that you're buying by 20% per year, yeah, maybe you could buy one Bitcoin for a lot cheaper than you can buy shares of Bitcoin, shares of strategy for that exposure. But over a long enough time frame, if he's able to continue doing what he's done over the last 3, 4, 5 years, all of a sudden you have more Bitcoin at the end of that time period in exposure to your common shares of strategy than you do for underlying Bitcoin. That said, there's obviously risk, there's leverage involved, and the simplest way to get exposure to the asset is probably going to be buying it directly or buying it through an ETF.
Mm-hmm. Do you feel like other companies are going to further follow this extended Saylor playbook? I mean, issuing debt, preferred stock, or is this kind of unique to strategy based on its current position?
No, I mean, we know for a fact there's other companies doing it. Adam Back just started a company in partnership with Cantor Fitzgerald. Cantor Fitzgerald's also doing another SPAC with Jack Mallers as the CEO, and Tether / Bitfinex is involved. You also have Mayoshi Son of SoftBank involved in that one. There's different ones popping up left and right. There's ones that started a couple of years ago, Semler Scientific. They're basically following the Saylor playbook. Saylor's been doing a conference for years now where he's trying to teach people why you should add Bitcoin to your balance sheet, why you're getting devalued every year just sitting in cash, and basically like telling everyone, this is how I'm doing it, this is how I think about it, you should do the same. And people are starting to follow. I just worry too many people follow, this kind of gets too big and people are going to get over their skis, and they're going to have to, basically people are acquiring a ton of coins right now, billions of dollars. I think some of these companies are going to end up coughing them up in the next downturn or some sort of blowout potentially. Again, when is that going to happen? I don't know. And I guess I could be wrong, but that's definitely the risk and something that I'm concerned about personally when I'm looking at the space. But I mean, Saylor's been doing this for a long time, and like I said, he doesn't have debt due until 2028. So it's not like he has to come up with a certain amount of money by the end of this year. Like, he's got essentially 3 years from now before he has to worry about anything. And even then, it's only $1 billion, which is like nothing to what he's been doing. He's been acquiring that on a somewhat regular basis over the last few months.
Yeah. Let me ask you, so do you think strategy could eventually become so big that it starts to influence the entire Bitcoin market? I mean, right now they got 600,000 coins. That's like over 3%. They're aiming for somewhere in the 4.3% if they acquire that 900,000. And if they become that big and own that much Bitcoin, is that kind of against like the ethos of Bitcoin to begin with, that one company holds so much of it?
Yeah, I mean, this is a question I get a lot with the ETFs. So the ETFs, the US spot Bitcoin ETFs here, own 1.2 million coins. So double essentially what Saylor owns right now. Granted, in the same way that Saylor doesn't actually own those coins, it's MicroStrategy or Strategy and the common shareholders own the rights to those coins for the most part. That's the way the ETFs work. There's people that are investing in those ETFs. It's not like BlackRock owns those coins. The real ownership is in the investors of the ETFs or Fidelity or Bitwise or what have you. So one, it does go a little bit against the ethos. It's supposed to be decentralized. It's supposed to be peer-to-peer cash. And this is like a centralizing factor. But over any time frame, any sort of technology and information, there tends to be a centralizing factor. And basically what Bitcoin needs to do is build things to make it more decentralized, easier to use, on-chain sorts of things. But also another ethos is Bitcoin is capitalistic. It's very libertarian minded. So it's free markets. And, this is free markets. And one thing people have to realize is they're fine to pay up a little bit and give people better exposure, whether that's the ETFs, if they can get convenience and exposure. Some people don't want to worry about their own cold wallet or hardware wallet or what have you. It's a lot easier. I have a brokerage account. I'm just going to buy an ETF to get exposure. I'm just going to use Coinbase and not worry about taking it on myself, which goes against the ethos. A lot of people, not your keys, not your coins. But there's plenty of people out there like my grandparents that they're never going to learn how to handle a hardware wallet with the way it currently operates. Like I have a hard enough time trying to send money on Bitcoin rails and things along those lines. It's heart wrenching, right? So there's always going to be certain levels of people. And also you got to realize institutions, they're incentivized to outsource this stuff. This is one of the things that a lot of people don't understand. You can't go to a pension and just be like, Tommy down in HR and somebody else are going to do a multi-sig coin to maintain our $1 billion of exposure to Bitcoin. Like, no, you need to outsource that with contracts or somebody else to take care of it. It's not going to be like an institution just has a couple people that are going to hold a multi-sig wallet to hold exposure to Bitcoin. There's a reason that Saylor has custodians that handle this. There's a reason that BlackRock and Fidelity and others have outsourced custodians that are holding this for them. And there's a reason that a lot of investors are going to choose to go this way for getting their exposure. And honestly, to be quite frank, normal people aren't going to be able to generate the type of leverage and take advantage of the volatility of a stock in the way that Saylor can to generate, increase Bitcoin yield, if you will. The question is just like, is he going to be able to do that into perpetuity? And what will he do with this Bitcoin over the long term? Is he going to come into a Bitcoin bank? Who knows how this will all work? But that's the way I think about all of this.
Yeah, I mean, there's a lot of questions on the horizon as these are really some unfounded times. And there's a lot of critics out there, or people that say that what Saylor's doing is brilliant. But there's a whole other camp that's saying this is really risky and we don't know where this is really all going to go. Where do you fall on that spectrum between that? Is this brilliant or is this just a little risky even for your taste?
I mean, there's no denying this has been a brilliant move by Saylor. I mean, just look at the performance of his company. Look at what the market cap is now. His company, he called it himself a zombie company, and now it's not. So no matter what happens from here, this was like a kind of a smart play. Is it going to get too big potentially? My main concern is with all these other sorts of Bitcoin treasury companies specifically. Are they taking on too much debt? Are they going to be service it in some way? Is there enough of a backing behind these companies that are spinning up? That's my main concern. And also, so I mean, the one thing that you really have to pay attention to here is like, obviously Bitcoin price going up is going to help any of these sorts of Bitcoin treasury companies. But at the end of the day, when you build up leverage into a system, it can come back to bite you. I mean, that's what happened with GBTC back in 2020, 2021. I mean, essentially what happened was things kind of blew up because too many people were leveraged GBTC and it was trading at a massive discount and there was no way to unwind that discount essentially. And that exposed a lot of bad actors in the space and people who are not taking risks seriously. And I suspect if we see a huge drop in Bitcoin, we're going to see a lot of, like I said, we're going to see a lot of these treasury companies cough up their coins. Do I think every single one of them is going to implode? Maybe not. I mean, there's intelligent ways to use leverage. Leverage is not inherently a bad thing, but if it's done incorrectly or at the wrong time or with the wrong sort of backing, it can definitely blow up in your face.
Yeah, no, absolutely. Stay put. We're going to go into the next story that I'm really going to want to get your opinion on. It is about the intersection of the cryptoverse and TradFi, and I know there's not many people better than you to chat about it with. Because in a plot twist that nobody had in their 2025 bingo card, PNC Bank, a 170-year-old financial institution that once feared Venmo, is launching crypto trading through Coinbase now. That's right. You'll now be able to buy Bitcoin directly from your PNC account without having to sneak off to another app like you're cheating on your banker. The move is powered by Coinbase's Crypto as a Service platform, which sounds like something invented at a Davos whiteboard, but basically means PNC can slap its logo on Coinbase's tech and pretend it's been crypto-friendly all along. In return, Coinbase gets access to some of PNC's traditional banking services because even in crypto, nothing says legitimacy quite like a savings account with a routing number. PNC chairman and CEO William Demchik called it a fast track to bring crypto financial solutions to customers. Or in other words, everyone under 40 is leaving us and we're beginning to panic. it's not a bad time to jump in either. PNC manages over $421 billion in client assets, so if even a sliver of that gets pointed towards Bitcoin, that's some real firepower. And it's not just them. JP Morgan Chase, Citigroup, and Bank of America all recently made moves towards stablecoin integration, which means the banks are officially here and they're very late to the party. But better late than never when it comes to their money and when there's money to be made. Blah. Now, this sudden wave of institutional enthusiasm comes hot on the heels of Trump's Genius Act, a bill that finally gave stablecoins a regulatory definition instead of treating them like radioactive monopoly money. With that clarity, banks are now scrambling to offer crypto services like it was their idea all along. Meanwhile, Bitcoin is up 21% over the last month, Ethereum is up nearly 70%, and XRP somehow is not dead yet and is even up 80%. So what happens when massive conservative banks like PNC start offering Bitcoin access to their clients? 2 words: demand spike. And with Bitcoin's fixed supply, you already know what that means. We're bringing James back. James, PNC just partnered with Coinbase to offer Bitcoin to customers. What does that tell you about where the big banks stand on crypto now?
Yeah, I mean, let me start over. I would say no matter where you look in TradFi, there are people at firms that have discounted this space, some since 2013, some since 2017. They've basically made a reputation saying this space is going nowhere. And a lot of them functionally just can't get to the point where to admit they were wrong, right? Like the way that like outcomes operate, it's not binary, it's not yes or no. So like theoretically, let's say the entire crypto space blows up. No matter how you look at it, the odds of there being tremendous success coming out of here has gone up dramatically over the last decade, even more so, even over just the last year or two, and people still are ignoring it. There are other people, though, that wanted to get involved in this space. Think BNY Mellon. They were ready to start custody services in crypto. There were other banks that were trying to offer different things to give their clients exposure to Bitcoin or crypto in a safe way that a lot of their clients wanted to. But the Biden administration, Gensler, the OCC, the Fed, they basically made it so it was impossible to do that. So even if PNC Bank a few years ago wanted to do some sort of integration to allow their clients to get exposure, there was no way to do it. So this goes back to what we were talking about in the beginning. There was no regulatory clarity. That is now coming into fray right now. That's part of the reason why we're seeing a lot of banks get involved. The stablecoin side of things is very critical for these banks. A lot of them have been toying with different things, specifically JP Morgan. I mean, they're even doing deposit tokens. They're testing deposit tokens on Coinbase's base, the Ethereum layer 2. Everyone's trying different things now that, like, you know, the door has opened up to get involved. And I think it's a good thing. So there's going to be two different sides of this, right? First side is what I was talking about. The people who discounted this whole space, said it was worthless. We're not investing in it at all. We're not paying attention at all what was going on. And there's other firms that were interested in doing this and were basically barred from getting involved at all. Those ones that were barred probably have some better understanding, have people in their ranks that know how this works and are ready to jump on this. PNC Bank obviously jumped pretty quickly to get Coinbase as a service on their side. So it'll be interesting to see how this all plays out. But the banks are scared. I mean, if you look at the Genius Bill, one thing that they excluded is that you can't pay interest. And David Sachs on his All In podcast explicitly said that was due to the banking lobby. So the banks are worried about this. There are two main reasons that you would use stablecoins. One is payments. One is basically if you're outside the US and you don't have exposure to a currency that's going to hold its value better than your local currency, that's what a lot of these stablecoins, specifically Tether, are being used for outside the country. So yeah, I think in the US, it's more going to be payments related and remittances and sending money around than necessarily like people are going to use stablecoins as their dollar savings account in the near term. But I think they could be big in payments over the coming 2 to 3 years. And obviously, there's a lot of investment in being able to do that. And we're seeing it at the level of Congress now.
Yeah, it just seems like the use cases for crypto in general, not just Bitcoin, are becoming too big to ignore, especially with the stablecoin legislation that we've seen passed recently. And TradFi just can't ignore it any longer. And the longer they do, the further behind they're going to be from the rest of the crowd. I mean, even Jamie Dimon over at JP Morgan, I think they're now going to be, they're talking about onboarding crypto into their platforms. And Jamie Dimon has called it a million bad things in the past, but even the biggest detractors seem to be acquiescing and joining onto the crypto bandwagon because they have to. Right. So that seems to be where we are right now. Now, James, I want to switch gears a little bit. I want to talk a little bit about you and get into our deep dive here because you've had a really interesting background. You've held several different roles across data, analytics, research. I would love to know, how did your background in data shape your approach to ETF and crypto research today? Because you certainly have a unique and informed perspective.
Yeah. So I was the guy that was in the back end of the Bloomberg terminal system that was setting up the relationships and the data feeds for, getting the pricing for the ETFs, getting the NAVs, the shares outstanding, talking to the issuers about how these operate so we can put the correct information on the terminal. So I knew how all the back end worked for ETFs, mutual funds, or hedge funds on our system. So I had a lot of relationships on that side of things. So basically, then I moved to BI, and I was like writing about that data that I'm used to covering. So I know how the back end systems work. I know how the infrastructure for the ETF ecosystem worked, which is why we were so bullish on what these Bitcoin ETFs and crypto ETFs were going to do. One of the things we were saying since 2020, I understood why the SEC didn't allow the Bitcoin ETFs to launch back in 2013 and even 2017. The market just wasn't ready. The institutions weren't ready to handle this. But by 2020, that really mostly had changed from our point of view. And that's when we really started writing that the SEC was in the wrong for denying these products. That's also when Hester Peirce was vehemently writing letters of dissent for the SEC decisions not to allow these things to go through. So that's basically my background of like why I started writing about research about ETFs. But when I moved over to BI, I also reported to Mike McGlone, who's our commodities research analyst. And I was working with him writing about commodities. And one of the things he wanted to do was like, that was 2017 when Bitcoin was beginning its run up before the Thanksgiving run up and the ultimate blow up in early 2018, late 2017. And so we were actually writing like crypto 101, blockchain 101, Bitcoin 101 type notes because a lot of TradFi Bloomberg clients were like, what the hell is this stuff? What is going on? We did write a note basically saying it was a bubble in December, which I mentioned that vitriol I wrote saying that GBTC could go into a discount, just like it was at a premium. The vitriol that Mike McGlone, my senior analyst at the time, got for basically saying that Bitcoin was in bubble in mid-December was even worse. But he was right. So yeah, basically anything you can think of, that's why I've been covering this TradFi DeFi overlap, why I do a lot of work. I view the whole space as building bridges. So I think of ETFs as building bridges. They're packaging DeFi crypto assets on the TradFi rails. So they're taking that DeFi asset, whether it's Bitcoin, Ethereum, or these other assets that are going to come, and allowing them to work on TradFi rails, which I think is a critical thing. It's good for convenience, it's good for end investors, but it's going the other direction too. Stablecoins, money market funds that are being traded on Ethereum, you name it. So tokenization in general, that's going the opposite direction. It's taking DeFi assets and putting them on, it's taking traditional assets and putting them on the DeFi rails. So that's the area that I'm most interested in, what I'm covering, which is why I'm fascinated by, the Bitcoin treasury companies or any treasury companies and all this tokenization, securitization, stable coins, all of that. I'm just fascinated at this overlap. I mentioned, I think everything is just going to smash together, and there's going to be aspects of both, worlds and economies that in a decade from now that are dominating the way that we look at our financial system.
Yeah, and with your wealth of knowledge, specifically in the ETF space, you've been a contributor to Bloomberg's ETF IQ, which I believe is the only TV show that's currently dedicated to ETFs. So I got to ask, what's it like contributing to a show that's so niche yet increasingly more relevant each day in this ecosystem?
Yeah, so ironically, there is another one that's a competitor from one of the clips you're showing. So CNBC actually has an ETF show as well, but we were first. I also do a lot of work with. We have another show. So the ETF IQ is Mondays at noon. We also have Bloomberg Crypto, which is Tuesdays at noon, and I help a lot with that, answering questions, go on the show as a guest very frequently. So it's very interesting. One thing I would say about ETFs, though, you're in the crypto world. A lot of crypto people think you're democratizing finance. You're doing all these things. What people in crypto need to realize is ETFs were that 10 years ago. They still are. They are really punk rock. If you were going to enter the ETF world, things are very cheap. The spreads are extremely tight. There are virtually no trading fees. If you compare that to the way that you trade spot crypto on Coinbase, on Kraken, you name it, the spreads are an order of magnitude wider. There's trading fees for every time you're buying and selling something for the most part. So ETFs really democratized things. They took it to Wall Street in a big way. Granted, Wall Street has benefited from the trading aspects of the ETF side of things, but for an end investor being able to get exposure to the S&P 500 and only being charged 2 basis points every year is insanely efficient. Like, they are a serious technology, and I view crypto and tokenization and those things as kind of like the next wave of huge technology moving forward as far as investment goes. So I view them both as forefronts of different things, and if ETFs are just further along in that movement. But it's interesting, you know, we get a lot of like really interesting guests on both, and there's a lot of overlap between the ETF show and the crypto show.
Yeah, no, I believe it. And I mean, and you've written and spoken a lot on these shows about the interplay between the SEC and crypto. What do you think the SEC is getting wrong or right when it comes to ETF regulation right now? And what are maybe some things you'd like to see?
Yeah, so I'm pretty much in agreement with everything that I'm seeing come out of the SEC. I know a lot of people are upset. We just had a couple of index products, crypto index products from Grayscale and Bitwise technically get approved, but the SEC issued stay orders basically saying you can't actually convert to an ETF yet. I think that's just the SEC getting all their ducks in a row. Everything I'm seeing written by Hester and Paul Atkins, they are concerned about fraud and manipulation and things that are clearly securities. They're like, if it's securities, we're still going to treat it like a security. Just because we think a lot of these digital assets are not securities doesn't mean we're not going to go after people for committing fraud and manipulation. So I agree with everything they're doing on that front. And like I mentioned at the earlier in the show, I think the next big thing that anyone should watch for is what I would call generic listing standards or some sort of crypto framework. The way that a lot of ETFs work nowadays is they have this generic listing standard. So if the underlying investment strategy or underlying investment asset meets a bunch of criteria that has already existed, they basically just submit their filings to the SEC and they can launch an ETF after 75 days, assuming the SEC doesn't try to stop them. With the way that crypto ETFs work is they have to go through this process. Basically, the exchange rules don't allow them to list, you know, a Bitcoin ETF or an Ethereum ETF or any crypto ETF. So even a new Bitcoin ETF that files has to work with an exchange that has to file with the SEC, something called a 19B4, and basically say, can you allow us with our listing standards to launch this? And there's a 240-day clock. It can take forever. It actually takes more like 260 days from initial filing. Like, that process sucks. What we understand now and what we're seeing signs of is the SEC is coming up with the same sort of rules that we're used to seeing for an equity ETF or a bond ETF for a crypto ETF. So we'll know that if the crypto meets this criteria, if it has a futures market that has existed for 6 months and has a certain amount of open interest in trading volume, if the underlying asset has a certain amount of market cap, if it meets these other criteria for diversification or decentralization, all of those things mean we're going to allow it in an ETF wrapper. So then you file, and 75 days later, you just basically have to put in those documents saying why you think it meets the generic listing standards. And then all of a sudden that ETF is going to list. So we're going to see hundreds of ETFs that are owning crypto in varying different ways, some digital, some single assets, some tokenized index structures, you name it. And the SEC, we think, is working on that right now as I'm talking about this. And we're looking to see something come out in the next month of them going back and forth between the exchanges and the issuers to get this done and up and running. And that's going to be critical for any sort of talk about what the SEC is doing as it relates to crypto.
Yeah, so I mean, it sounds like we're on a good path, but there's still a lot of things that need to be settled going into the future. And we certainly appreciate you joining us today, giving us your insight and expertise, as you are literally on the bleeding edge of one of the most interesting parts of this monetary revolution that we're going through right now. So we certainly appreciate your time and expertise today. Before we let you go, James, I'm sure there's plenty of people in our audience, much like myself, that are like, man, I wish we had more time because I need to hear James talk more about all of this so I can get a better idea of where this is headed. What's the best place for our audience to check out what you're up to and follow your musings online and beyond?
Yeah, I mean, the number one way would be to have a Bloomberg terminal, but those are obscenely expensive. So that's where all of our work and the detailed work is going to be. Unfortunately, that's the only place we can share like the full length of it. But we do a lot of sharing like charts and data and our thoughts and on breaking news around anything I was just talking about, right? So that is shared on Twitter, like you have up there at JSafe. and my boss, Eric Balchunas, we are very active on covering anything that's going on in the space, more so than almost anyone. There are a few others that I could think of, but for the most part, this is where you can get us if you don't have a Bloomberg terminal. And obviously, like I mentioned, ETF IQ and Bloomberg Crypto. And then finally, I do a lot of work with Laura Shin at Unchained. We have a podcast called Bits and Bips that I'm talking most weeks. So yeah, I mean, that's where you're going to get the most of our stuff. But if you really want to get the deep, detailed analysis that we're going into, you would need a Bloomberg terminal, unfortunately.
I got it. So
and I come on
X
podcasts
Bits
like
and
this and
Bips.
TV and streamings. Sorry.
Yeah, exactly. So there's a lot of places to check out more of your work, and we certainly appreciate you sharing all of your insight with us today, James. And they won't buy me a Bloomberg terminal here, so we're going to have you back on the show again sometimes, because I could just listen to you chat about ETFs all day, my man. I really appreciate your time this morning, and thank you for stopping by the Blockchain Report. It was an absolute blast having you.
Yeah, thank you for having me. This was a lot of fun. We covered a lot of topics. The one thing I would say is like things are going in the right direction, both from a government regulatory point of view and from a regulatory agency point of view, SEC, CFTC, Fed, OCC. So if you're in this space, things that were headwinds just 10 months ago are now tailwinds. And it's looking pretty good as somebody who's been upset with the way this space has been covered in recent years.
Love it. All right, gang, you heard it from the motor that makes the ETF Bloomberg terminal machine go. James Seyffart, thank you so much, James, for your time. We hope to see you again real soon.
Thanks for having me. This was fun.
Cheers. Thank you. All right, gang, let's go. Bullish, bearish, BS. Let's wrap it up. Run the stinger. Let's do this thing, guys. We got like 3 minutes. All right, it's time for Bullish Bearish BS. Let's see how things are looking for our beloved Bitcoin as a result of our top stories of the day. Let's recap. First, Senate Republicans just released the Responsible Financial Innovation Act, a draft bill designed to clarify digital asset regulation. It builds on the House's Clarity Act, updates the 1933 Securities Act, and aims to clearly define the roles of the SEC and CFTC while protecting certain crypto tokens from being labeled securities. My verdict on this, I'm bullish. I mean, sure, it's still a draft, but it's a second major legislative push in as many weeks, and this time from the Senate. That kind of momentum in both chambers signals growing political will to finally bring crypto regulation into the 21st century. And while we're still a ways off from signed law, the writing is certainly on the wall. Bitcoin is being taken seriously in Washington, and I'm bullish on that. Next up, we got Trump Media just closed a $2 billion Bitcoin and BTC securities purchase. Max Keiser is accusing Trump of stacking sats before the government reserve can do the same. Critics say it's a conflict of interest. Supporters call it leading by example. I'm calling it bullish. I mean, it's really simple, guys. Whenever your opinion of Trump is a $2 billion Bitcoin buy is a $2 billion Bitcoin buy from the man at the top. Trump just went full chat on Bitcoin, and how can you not be bullish on that? And last, Fundstrap's Tom Lee is doubling down on his Bitcoin price prediction, calling for 250K this year and a long-term target of 3 million. My verdict is bullish too. I mean, Tom Lee isn't just pumping for clicks. He's a longtime analyst with a proven track record. So you got to take his opinion seriously, gang. I mean, 250K might feel like copium, but Lee's been right before, so I'm feeling bullish on this. So today's score, we got 3 bullish, 0 bearish, and 0 BS. So today's sentiment, overwhelmingly bullish. Regulators are circling the wagons. Trump's buying the dips, and Tom Lee still says we're early. Thanks as always for watching the Blockchain Report. I'm Hank Hudson. Make sure to like, follow, and subscribe to RoxomTV and me at Hank at RoxomTV on all platforms in the world. I'll see you tomorrow for more Blockchain Report. Sayonara.